fundsupermart.com.
Entering into the last quarter of this year, while we're still bullish on Asian bonds, let's hear some insights from Boon Peng Ooi, the Chief Investment Officer at Eastspring Investments. Hello, Boon Peng. Thanks for joining us. In general, what are the key drivers for Asian bonds over the next 1 to 3 years?
In the next 1 to 3 years, which is generally over the medium term, the main drivers would be three things. Firstly, it would be our expectation that currencies for Asia is generally on a long-term appreciation trend. Now, why do we have confidence that this will happen is because of the fact that for most Asian countries, there is a persistent current account surplus, which it enjoys against the rest of the world. At the same time, the foreign direct investments into these Asian countries continue. And also, capital flows as a result of the safety and the financial strength of each individual country generally also attracts capital inflows. The other part which generally we feel are drivers for the Asian bonds, Asian local bonds, is the fact that the corporate bond market is increasing in size across the Asian countries. Especially we have observed a lot of new issuers coming into the Singapore bond market, and these new issuers bring with it investment opportunities, value opportunities that we can take advantage of. The third thing which will help drive is just the general level of yields. We are able to get from our Asian bond fund over 4% returns for yield to maturity, and that gross yield to maturity generally is more attractive than what we can get in the G3, G7 developed bond markets. So we feel that as long as interest rates remain stable, as long as central banks across the world keep to its current monetary policy stance, which we think can last for quite some time, the stability and attractive running yield of Asian bonds generally will provide the third leg of the returns over the 1 to 3 year horizon.
So, do you believe that QE3 will result in upwards pressure in bond yields? And what's your take on its impact on the Asian bond market going forward?
Generally, if you have an increase in liquidity, the impact is to actually result in yields falling, which is exactly why the Fed has continued its QE policy, because it has had an impact of depressing yield levels. And in turn, there will be spillover into the Asian markets, which then will affect and depress the Asian bond yields. The only reason why a QE3 would result in higher bond yields if it brings about an inflation risk, a heightened inflation risk, which will happen if the excess liquidity results in excessive credit creation. That can only take place where the banks start to lend in a very aggressive fashion if the general economy begins to pick up, in which case then the inflation risk will be quite considerable. But as you can tell from the actions of the ECB, the Fed, and the Bank of Japan, that confidence of a strong recovery in the developed markets is not there. And at this point, as we speak, the confidence in the China recovery is also not very clear. So we don't think that QE3 will stop inflation fears and therefore cause bond yields to rise. In fact, the persistence of QE3 will have a tendency to cap interest rates globally. Now, as we said, the QE3 that is being pursued in US, the ECB's bond buying policy that was announced over the last about 2 weeks back, and the Bank of Japan's asset purchase program, all will cause some spillover flows into Asian markets, and therefore it will also have the impact of keeping a lid on increases in Asian bond yields.
In Asia, which markets and bonds have the greatest upside potential?
In the Asian local bond space, essentially what is important is relative value. As you know, bond yields among Asian bond markets will tend to correlate with each other, and there will be periods whereby one country will feature as relative value, better value than another country. I can tell you what we generally like right now, given where interest rates are in India. We feel that buying short-dated Indian rupee and short-dated Indian rupee bonds is quite attractive. We do not see the Indian Central Bank or the Reserve Bank of India cutting interest rates, given the fact that they have just raised the diesel price, and that will lift up inflation, and therefore we think the RPI will stay on a steady course. But meanwhile, as you hold the short-dated Indian bonds and the currencies, we think you will get the running yield returns and also possible upside for the Indian rupee for the short to medium term. The other currencies which we see continuing to appreciate is the Sing dollar. That is something that has benefited our portfolio. It's because we feel the Monetary Authority of Singapore, in its coming meeting, will continue to pursue appreciating Sing dollar policy. There might be some moderation in how much it appreciates the currency. As you know, the MAS, or the Monetary Authority of Singapore, uses the currency as the means of attenuating the monetary conditions. So given that inflation remains on the high side, given that we still have asset prices like property at an elevated level in Sing, we think they will continue to keep the Sing dollar strong. So for both these two currencies, we feel are opportunities in the Asian bond market. And as I alluded earlier, we continue to enjoy the high running yield of Asian bonds, and we can take advantage of the corporate credit issuance from new entities that will provide opportunities for this fund.
So what are the risk factors of investing in Asian bonds?
The risk factor would be like similar, in a way similar to Asian other emerging market bonds, which is you have another Lehman-like event. This could come about if you have a sudden and unexpected collapse in the Eurozone, where things begin to unravel very quickly because the political will to keep the Eurozone together suddenly begins to disintegrate. And there is always this risk, and if that's the case, then what generally happens is that there will bring about a period of quite extreme risk aversion, whereby international investors will start pulling back their funds into their home countries, and therefore result in weaknesses in the Asian bond markets as part of the general weakness in the emerging bond markets. It should be noted that our view is that the Eurozone leaders, we feel, will actually continue to ensure that this euro stability is kept intact. It's very important because this is something where there's a lot of political capital invested into the euro, creation of the euro, and the sustenance of this euro is something which they would be in interest to keep, because the cost of unraveling the euro at this point is far higher than the cost of unraveling the euro is much higher than the cost of keeping things together. So we feel that the European leaders will make sure that the euro remains intact. We believe there's adequate political will.